Have you ever struggled deciding what ETF to invest in? There's just so many options out there that sometimes it can seem a little bit overwhelming. Well, if you can relate to that, then don't worry, because in this video, I'm going to tell you what the best single ETF portfolio in Canada is. And this is for people that are looking for an investing strategy that's super simple, that's practically on autopilot, that doesn't have very high fees at all, and that's also going to return a solid ROI over time. Now, bottom line up front, if you just came for the conclusion, in my opinion, the best single ETF investment portfolio in Canada is the iShares Core Equity ETF portfolio, or ticker symbol XEQT. And if you want to stick around over the next few minutes, I'm going to break down why a single ETF portfolio is a great way to invest. I'm going to discuss why I think XEQT is the best single ETF portfolio in Canada. And I'm also going to touch on some of the other options out there and tell you why I chose XEQT over everything else. Okay, so first things first, what is a one fund or a single ETF portfolio, and why would you choose to invest that way as opposed to picking and choosing individual stocks? Well, simply put, the vast majority of investors that try to pick and choose individual stocks, ETFs, bonds, or other types of investments actually underperform the market over time. And so that means that the safest way to invest, and also the best way to get solid return on investments over a long period of time, is to simply buy an overall market index. And the simplest and easiest and also cheapest and most autopilot way to invest is to choose a single ETF that tracks the entire global market, or at least a large section of the global market, and just put your money into that over time. The pros of the single ETF portfolio strategy are that it's incredibly well diversified. With an ETF like this, you're buying fractional shares of thousands of companies all around the world. You're paying very minimal management fees, much less than you would pay to invest through a mutual fund or other types of investment vehicles. It's incredibly easy to keep your portfolio balanced because, well, you don't actually have to do anything aside from dollar cost average into the single ETF over time. You don't have to spend a lot of time or energy trying to pick and choose individual stocks or ETFs that you think are actually going to outperform the overall market. And barring any significant economic crash, you're going to see solid return on investment over time. Now, there are a few cons to adopting the single ETF investing strategy. First of all, you will have to pay an annual management fee to the ETF managers. And while that fee is definitely less than investing through mutual funds, if you just bought individual stocks, you wouldn't have to pay that fee at all. Also, when you pick and choose individual stocks, it is possible that you'll pick a winner that's going to outperform the market. And so by investing in this strategy with the single ETF, you're guaranteeing that you're not going to outperform the market. You're going to perform exactly on par with how the market is performing. However, if you decided to take some more risk and to take the matters into your own hands, it's possible technically that you could outperform the market, although like I already mentioned, the vast majority of investors do not. But in all honesty, in my opinion, the pros well outweigh the cons, and whether you're a beginner investor or an experienced investor that just wants to have a simple autopilot investment, this is a very easy way to do it that's practically going to guarantee you solid returns over time unless there's a massive crash and a massive depression. Now, before telling you why I chose XEQT as the best single ETF portfolio in Canada, I should just briefly mention that there's no fixed income or bonds in this portfolio. It's all equity. And so a portfolio like this would be for people under, let's say, the age of 50 or 45. It's going to vary depending on what your risk tolerance is. But as you get closer and closer to retirement, the recommendation is that you start to shift at least a certain percentage of your investments towards more stable, more secure assets like fixed income and bond. So what is XEQT? Well, like I mentioned, it's the iShares Core Equity ETF portfolio. It's trading for $27.24 on the Toronto Stock Exchange, and over the past 3 years or so, it's had a 44% return on investment. In terms of a couple other quick facts about the ETF that you might want to know, they've got almost $1 billion under management, so you know there's going to be a decent amount of liquidity. There's a management expense ratio of 0.2%, and there's an annual dividend yield of 2.27%, which is honestly not bad, since the purpose of this is really to see growth over time in the principal. Now, at this point, if you're asking, how can you have one single ETF make up your entire portfolio? Let's look at what's actually in the ETF. For starters, there are 9,602 companies that are held within this ETF. So every time you buy one share of XEQT for $27.24, at least as of the time of this recording, you are investing in tiny fractional amounts of 9,600 companies worldwide. Now, if we look at the breakdown of where those companies are, you can see that 47%, or almost half of this ETF, just tracks the total US stock market. So every major company that's listed on stock exchanges in the US. Next, you've got 25% of the portfolio that's tracking the total Canadian market. The third largest holding at around 23% tracks developed markets worldwide. And then the fourth largest holding at just under 5% tracks emerging markets worldwide. They've also got a breakdown by region with this map here, and you can see that the vast majority of investments, 70%, is in North America with the US and Canada. But then you're also getting exposure to other markets worldwide, for instance, Japan, UK, Switzerland, France, Germany, Australia, China, and the Netherlands. Those are the top 10 anyways. So that means that when you buy one share of this ETF, you're basically investing in every single company around the world that's worth investing in. And with such broad diversification across a variety of different markets, with 10,000 companies practically held within this, that's why you can have a single ETF portfolio, because you're gaining exposure to so many companies that it's really a risk-averse way to invest in equities. Now, like I mentioned at the beginning of the video, there are other options out there. There are other ETFs that track the global markets, or that track, for instance, the total US market, which is probably a pretty solid proxy. But let me tell you why I chose this ETF as opposed to any of the other ones. First of all, Vanguard has a very similar product to the BlackRock ETF, that's VEQT. This one's also an all-equity ETF portfolio that tracks the total global market, and it actually has over 13,000 stocks as the underlying holdings. But there's a couple of reasons why I didn't choose this one. First of all, it's slightly more expensive per share, which means that it's just probably a little bit less easy to put small amounts of money into this and to continue dollar cost averaging over time. And this is especially important for people that might have just a few dollars every week or every month to put towards this. If you can keep purchasing more shares, it's better because you have that snowball effect over time. Also, the management expense ratio is just a few points higher, and I think that could eat into your profits over time. Realistically though, these two ETF products are going to have very similar results in the long run because they're pretty much tracking the same thing. And while I don't think you could go wrong with either, I think XEQT is just slightly marginally better. Now, if you're still looking for a one fund, a single ETF portfolio, but you don't really like either of these, there's definitely other options. For example, you could invest just in the US total market. There's XUU, which tracks the total US market, including large cap, mid cap, and small cap. Or you could even narrow it down a little bit further and invest in just the S&P 500. For example, we've got VFV, and both of those would probably be very solid options. The thing about only investing in the US market is that you could be missing out on growth opportunities worldwide. And also, since you're decreasing your diversification a little bit, if there's a crash, for instance, in the US that doesn't hit Japan as hard, or Canada, for instance, then your portfolio might underperform. That said, generally speaking, the US market is the benchmark for global economic success, and that's why ETFs like XEQT put almost 50% of their total portfolio into the US market, because they know it's going to yield some of the most stable and secure return on investment over time. Anyways, thanks so much for watching. If you enjoyed this video, you might also enjoy this one. Have yourself a great day, and I'll see you later.